Hi, this is David Roach, Independent Strategy, Quantum Economics, whoever you are, wherever you are, whatever you're at, hello. I'm going to talk today about the sawtooth recovery, which is to give you a roadmap of where we are in terms of the economic recovery and why we are where we are and where we think it's going to lead. Now, this is a tool which will allow you to think about the economy, asset classes, even equity markets and sectors, and stocks individually. It's a reflective tool, not necessarily a prediction. Let us now try to get into the presentation, which I will use while I'm talking to you. So here we are, the sawtooth recovery. This is a traditional recession, and you can see how it works. You're buzzing along a trend line for demand and output. Both are the same in these curves because they are measured after any imbalance between supply and demand is resolved. So when you see demand, it's supply. When you see supply, it's demand. That's simply bad drawing of the graphics by me. You go into a recession and wages and asset prices are destroyed to an extent. And there may also be a destruction of capital in banks leading to a lending crisis. In any case, the economy goes down and then slowly at the bottom, animal spirits revive. And the wealth of households, corporate balance sheets and bank balance sheets are rebuilt slowly, gradually. And your output recovers to trend. Now, that trend recovery can often lie below the previous trend for a long time because of legacy problems. We saw that in the great financial crisis when it took forever for the bad debt problems of banks to be worked off, sovereign debt problems, and so on. Now, however, we want to switch and we want to look at the sawtooth recovery. It's significantly different to a normal, in inverted commas, historical recession. Why is it different? The first is jobs. During the pandemic recession, there were payments to workers either through their companies or directly by governments, which was essentially a social wage. So people got paid, but that payment was not related to output. There were various models. In Germany, they stayed employed by the company, but the companies were paid to pay them. And in the Anglo-Saxon model, they lost their jobs, but they were furloughed and got money directly from the government. In any case, disposable income did not suffer during this recession. In fact, disposable income increased by about 20%, and it couldn't all be spent. So there were excess savings rates. And in considering excess savings rate is actually the stock, which matters, not the flow, because the stock of excess savings can either be maintained or run down. And whatever happens to those excess savings will determine how big the demand boost is once people are able to spend their money in the ways that they want. Then there's the corporate and bank balance sheet issue. There were virtually no defaults during the pandemic recession. No credit crisis. Government and central banks guaranteed the debts of corporations and guaranteed, therefore, the banks. And the wages paid by government, of course, do not impact corporates' income statements or cash flows. So corporations were able to continue to invest to replace workers with robots, which we'll come back to in a minute. But what it really means is that lost value-added jobs are not getting replaced when the economy recovers. And of course, this sounds like a free lunch, but there's no such thing in economics as a free lunch. It was all funded by government deficits and rise in government debt to GDP ratios, sovereign debt ratios. Governments increased as a proportion of GDP by between 14 and 25%, depending on which economy you're looking at. And debts, that's sovereign debt as a ratio of GDP, jumped from 100% to 130% of GDP. Now, of course, This was a huge amount of money for the governments to become more indebted about. And the only reason they were able to do it was because central banks stepped into the picture and purchased government debt, which is direct monetization. And of course, ends the independence of central banks as an institution. But the central bank balance sheets, they really did the miracle of the loaves, the fishes, and the wine. And ECB's balance sheet increased from 40 to 70% of GDP. The Bank of England and the US Fed about the same. They both increased from 15 to 40% of GDP. Bank of Japan outdid them all and went from 30 to 130% of GDP. The result of this is very simple. It means that the governments and central banks are now linked together in unholy matrimony, which means that big bloated governments will not shrink. Impossible. The cost of capital cannot rise to reflect the level of their debts. And the result is, of course, that you get a low productivity, low growth economy with substantial inflation. That's called, of course, harking back to history, even if it is not exactly repeated, but just rhymes, it's called stagflation. Then, of course, there were asset prices. The asset prices come from the fact that so much money is being printed, much more than the actual economy needs to function, even though that might have been socially necessary at the time. The biggest asset price going in the world is, of course, housing, which, because mortgages cost very little, if people own their houses and have borrowed money to do so, and the house prices continue to rise, which they're doing at between 12 and 17% growth rates per year, then people get richer because the equity in their houses rise, which is the equivalent of the house price less the mortgage, which costs very little. And therefore, there's a wealth effect which continues to drive the economy until such time as it reverses when interest rates start to hit house prices and they come down with a wallop. And so then will, of course, people's feelings about their own wealth. Now we want to look at a schematic of the sawtooth recovery. Let's think about what actually happens and why it recovers. I've described the balance sheets and the income statements. Now I want to look at how that translates into demand and into output in the economy. And then once we've done that, we can integrate the thorny problem of supply side disruptions. Well, here is a schematic of the sawtooth recovery. The sawtooth recovery is, as I stressed in the beginning, both demand and supply. One causes the other with a little lag. And in the graphics we've drawn here, we assume that any differential between supply and demand has been resolved ex post, which means after the fact in economics. So they're about the same. What you get is excess pent-up demand in reopening sectors followed by normalization as demand gaps get plugged. So you get massive growth from excess demand, fueled, as I say, by these robust balance sheets, excess savings of households, and by the fact that corporations and banks did not suffer. And once the demand that generates is met and supplied, then, of course, demand and output starts to fall back to a trend line, which we will discuss in a moment, which is probably not the blue trend line you see here, which indicates that the trend before and after the pandemic is the same, which it probably is not. Now, why does the excess demand go away once it reaches the peak of the sawtooth recovery, the kind of jagged edge of the tooth itself? The reason it goes away is because if you're locked down, and you can't go to the movies, and you can't go to restaurants and cafes, and you can't go on holiday, the minute you're freed up and allowed to go out and do these things, you go and do them. But how many meals can you eat? How many movies can you watch in a cinema? And how many holidays can you go on? Well, the answer is they're all limited, partly because you are now starting to see a position where you will have to earn the money to do these things, so you still have a substantial excess savings in your balance sheet, but also because, frankly, the human feelings of satisfaction and happiness from consuming all these things fades very quickly when you do so once. It's certainly less when you do so twice, and even less again when you do so 3 times. So being less satisfying, you consume less of them. Now, supply side disruptions, which I'll just touch on, are as important as pent-up demand. For example, we will come back to dealing with the automobiles and China. Automobiles are not enough chips around to make our nice new shiny electric vehicles. So even if we want to have a car, we can't have a car. So as soon as the auto chip issue is resolved, we will get our cars and we will consume our cars. And there's a limit to how many cars we can consume. So once that excess demand is met, the trend line in output and in demand will start to go over the sawtooth peak and decline to trend and below trend. Similarly, in China, we have a lot of problems to do with electricity, to do with the credit effects of the real estate excesses, and I can go on. But the reality is that once China normalizes, and it has, of course, been boosting hugely its manufacturing production to satisfy demand for goods from the West, once that goes over the sawtooth recovery, China's growth will also decline towards a trend growth rate, which is much lower than anything we've seen in the past, because the country has so many unresolved problems relating to excessive credit for generations, bubbles, asset bubbles driving the economy, particularly in real estate, fiscal spending, which has already been spent and where debt levels are now for the government and local governments nearly 100% of GDP. So we're looking at a growth rate in China which comes in substantially below anything we've ever seen. And it too is on the way down. Now, if you look at this particular map, you can see that the US, China, global manufacturing, and the UK are deemed to be over the top of the sawtooth recovery, that strange pattern of output and demand, which is created by excess savings and the liberation of the economy. It's obvious that China recovered first, the US second, global manufacturing was the driver, and the UK was very close behind the leaders. Once the leaders have done their leading, which is the point about supply satisfying demand, excess demand, then of course they start to subside towards the trend growth rate, but first they will dip below it. Now, interestingly enough, in that group, you will see negative growth because the first derivative of growth starts to actually drop, say from 10 to 3% year on year. If you take that as simply an example, that means quarter on quarter, week on week, you're actually looking at contraction. Now that upsets markets enormously. We'll come to how in a minute, but it is certainly beyond the perception of normal people. What you then hope for is that the Eurozone, services, automobiles, and Japan will come along, and eventually emerging markets will come along, and they will provide a new peak to excess demand from the sawtooth recovery. Now, this is very important because it introduces two economic concepts, which I will deal with quite briefly, hopefully, and in comprehensible terms. The first is the temporal perspective. You're looking for the US to be in one position in the excess demand curve, in the sawtooth recovery, and you're looking for the Eurozone to be in another position. So you could say the same for global manufacturing and for services. You would look for services to take over from global manufacturing, for the Eurozone to take over from China and the US as the drivers of recovery. That's a temporal perspective. It is also, as you will have noticed, a geographical perspective. As the US goes over the top of the sawtooth recovery, then the Eurozone starts to replace it. So you need these two things to work together in order for the sawtooth recovery not to lead, as it appears to be doing at the moment, to a generalized slowdown in global output and demand. In other words, trending closer to what people fear might be a very low growth environment, and of course, the possibility of higher inflation. Now, let us turn for a second and integrate into this the idea of a supply-side shock. Now, in a supply-side shock, this is the graphic that you get, or something like it. You have the pre-crisis demand and supply growth trend, which you can see in the blue line. You have the peak of the pandemic, which is the trough of the recession as a dotted line. And then you have your sawtooth recovery in terms of excess demand and output, more or less matching that demand. But then something happens. You don't get the supply. The supply starts to lag the demand. Now, the immediate thing that this does is to limit demand. But I would make 2 points about supply based on China's issues of supply disruption, which are probably durable, and China's problems about transiting to a new type of economy called common prosperity, which is far more oriented towards lower growth and income sharing than it is on wealth creation, which may or may not be a healthy thing. I think it's a healthy thing, but it nevertheless has high transition costs, and it makes it look likely that China will have a much lower growth rate. Okay, so what you get in the post-pandemic environment when you have supply chain shocks worldwide, whether it's natural gas, whether it's shipping, whether it's air freight, whether it's coal supply in China, electricity shortages in China and India, and even in Ireland, and so on. All of these localized crises that we dealt with in a previous video called The Door Beyond, all these crises actually coalesce and become global issues, global supply side shocks. What this actually does, as you can see from this graphic, is to reduce supply below demand in two steps. The first step is that coming out of the pandemic, there is a share of existing investment, existing capacity, which is now useless. It's useless because demand has shifted. People want to live their lives differently. And it's useless because there are mismatches in the markets. Now, what are those mismatches? Well, apart from the supply side disruptions, there may be mismatches, which are also supply side disruptions of a structural sort in labor markets. In other words, the skill sets of the available labor may not match those which is being demanded by employers, which we can see in the unfulfilled vacancy figures for the United States. We can see the fact that people have decided to live their lives differently. Many of them will not return to the labor force. Many people have founded home-based businesses which allow them to lead a quality of life which is better even if their income levels are lower. Many women in the world, particularly in temporary employment categories like in Japan, have decided the workplace is so toxic they don't want to go back there. And I can go on. But the reality is that there is a very good argument to say that you lose a slice, a swathe of existing capacity, which causes the supply and demand curve of the sawtooth recovery to converge with a level below the blue trend demand and output curve or trend, which was there before the pandemic. So you drop below it, number one. That is not only the result of excess demand getting satisfied, it's also the result of the fact that supply cannot match that any level of demand that was implicit in the trend recovery line of demand and output before the pandemic. The second factor, apart from the downward shaped elbow in the supply and demand curve, the output curve post facto after the pandemic, is the fact that it will rise at a slower rate. What that means is the growth rate of demand and supply is going to be slower than before the pandemic. I would give you one example of this, and that is that China, which supplies 28% of the world's manufacturing products, and even if there is a switch to more service demand in the world, it nevertheless means that China is not going to be supplying this anymore because itself is switching to a domestic demand-driven, service-driven, common prosperity model, which implies a much lower growth rate. So the supply curve going forward is not of the shape that we assumed in the previous graphics. It is both at an absolute lower level and it is at a lesser slope upwards, which means slower growth rates. Now, this is very, very important because the supply disruptions imply that inflationary forces are there. And if those disruptions are structural, which I would pretend in many areas which we discussed in The Door Beyond, they are, then the lower demand curve, the lower output curves will not be matched by lower inflation, but by higher inflation. And that actually means that you move into a stagflationary world. It also means that profit margins in companies come under pressure because as the demand curve converges with a lower trend line, cost curves will not. and therefore margins get squeezed. This introduces two factors into financial markets. One is bond markets still have to catch up. Interest rates are going to be higher, and the economy itself will be more cyclical, which means higher risk. It also means, of course, that much of the production which we previously saw coming from global supply chains, which have now been shown to be liable to disruption and very risky, these will be repatriated. That means de-globalisation. De-globalisation will in fact be a measure to ensure the security of supply chains, but it comes at a cost, a higher economic cost. It was cheaper to produce things under globalization than it will be under regional economies or national economies as a basis for going forward. But that is the way that we are going to do things. It will also match, of course, the political aspirations of our dear leaders, certainly in democratic states, which will want to have the maximum production at home, even if it is not particularly productive, and ensure that they can continue to generate income enough to pay social wages to keep the populations happy and keep them in power. Thank you very much for watching. That's it from David Roach.